So to me, deep value is fundamentally about identifying things you're getting for free that are owned within a conservative capital structure. So what we try to do is we try to reduce down to the greatest extent possible a kind of stub value that we can then say, okay, here's what we're really paying for what we know least about. So an easy example, we're all cap, we're 70% micro and small cap because it's just obviously a much less efficient part of the market. But post-Katrina, we bought Berkshire. And this is what we do with small situations, but Berkshire is just an easy example. So we simply took its cap, we subtracted out its cash, we subtracted out its bond portfolio, we took a 20% discount to its public securities portfolio, and we came to a stub value. That stub value, as I recall, was maybe $75 billion, is my recollection. So that's what we were paying for the flows coming off the private businesses, the Dairy Queens and Geico and whatnot. So we could reduce down, okay, this is what we're paying for the piece that we don't know quite as what it's worth. And I think we were paying roughly 7.5 times pre-tax earnings, which was a great. So you own this collection of fabulous businesses at a great multiple. So it's kind of banging it down to what you don't know, and then connecting that to the piece you don't know. So current example right now, another large cap. We have been recent buyers of Samsung. So $150 billion cap company. Subtract out cash and about a 10 multiple for its non-mobile business, so consumer electronics, chips, etc., and you basically have the market cap. So you're getting mobile for free. So you start with that cap, the things that you know what cash is worth. They've got some bonds as well in addition to the cash. You can put a 9 multiple on their non-mobile business. They dominate in chips. They've got obviously a big share in consumer electronics and TVs. You can then see, well, what am I paying for the mobile business? I read the headlines. I know it's getting its butt kicked by Apple. Okay, fine. It's worth something more than zero. I mean, it did earn $12 billion last year. So if it only earns $3 billion this year, okay, well, it's worth something. And, there's an optionality that they'll find ways to compete with having 25% of the smartphone market on the planet. So we're always trying to reduce down. And so one of the risks in what we do and why we are often averaging down is because the headline is typically what's capturing investor attention. So the investor attention right now is mesmerized by Samsung's drop in their mobile business, and that's what they see. Now, we were buyers 18 months ago of Apple when it was receiving deep sentiment change, when it had at that time gross margins of about 40%. The thinking was they were going to sub 30, that it was just a commodity, it's just a piece of hardware. Look at Nokia's margins, and that's where Apple's are going. Again, we basically said, okay, let's take gross margins at that time down to 28%. Let's put no growth on it. Let's look at the enterprise value today. And if that happens, we had them still earning $30 a share. It's obviously pre-split, which was 10 times earnings. So again, reducing down, and okay, now what's the risk? So, but for a while, we bought Apple at $540. We bought it at $450. We bought it at $395. And so in terms of lessons learned, I wish it were different, but in our planting phase, and I see this business and what we do is basically planting, harvesting. And in the planting phase, it is not uncommon to be averaging down. And I think it takes a certain type of temperament to continue to buy and to understand really deeply in your bones that this is a business about what's your average cost, not what's your first cost. And you have to have conviction in your analysis. And I think, we wouldn't have had the success we've had over the past 16 years without averaging down. We actually have a decent record of capturing, and we've done a tremendous amount of self-assessment. So we know a lot about what's worked, what hasn't, if we've been early, and I think that's something investors have to do. I give a lot of credit to my partner, Ted Crawford, who's a Columbia Business School graduate, and when he came in a few years back, he really focused on, we need a database of every trade we've made. We need to know where it traded in the subsequent 12 months and 24 months. Do we have a pattern of buying early? What hasn't worked? We know a lot about, which I'm happy to talk about. We know a lot about our securities.